Welcome to the deep dive.
Good to be here.
So today we're tackling Brookfield Asset Management, ticker BAM.
Right.
Its stock dipped below $55 recently.
Yeah, I saw that.
And we're digging into a Motley Fool piece from yesterday, April 26th. The question is this JIP maybe a buying opportunity?
An interesting question for sure, especially for folks interested in alternative assets.
Exactly. Or, just understanding what drives these stock moves and dividends. So our mission today is really to pull out the key insights from this article on BAM's situation and future prospects.
And the starting point is that stock performance, right?
Yeah, the article flags that straight away shares are down more than 15% from their peak earlier this year.
Okay, so maybe let's start with the basics. What exactly is Brookfield Asset Management?
Good point. The article describes them as a leading global alternative asset manager.
Right, so not your standard stocks and bonds, but things like infrastructure, real estate.
Renewable energy, too, I think.
Yeah, those kinds of assets. And they're big. The piece mentions an $87 billion market cap as of, April 25th?
That's right, $87 billion, so a major player.
Definitely.
But here's the interesting part. Despite that stock dip, the company itself seems to have had a really strong run lately.
Oh, yeah. What did the article say?
It called last year an excellent year. They generated nearly $2.5 billion in fee-related earnings.
Okay, $2.5 billion. And how does that compare?
That's up more than 10% compared to 2023.
So, solid growth there.
And it seems like it's actually, accelerating.
Accelerating how?
It's tied to their capital raising. The article highlights this. They pulled in a massive $135 billion in the last year.
Wow, $135 billion. That's serious capital inflow.
And get this, a record $29 billion just in the fourth quarter.
Okay, so that's fueling things. That increases their fee-bearing capital base, right? The money they earn fees on.
Exactly, and the numbers back it up. An 18% increase in that fee-bearing capital in Q4.
And that likely translates to earnings.
Yep, a 17% jump in fee-related earnings in that same quarter. So real momentum.
That does sound like acceleration. It's not just backward-looking either, is it?
No, definitely not. The article quotes Brookfield's president, Connor Teskey.
Yes, Teskey. What did he say?
He's apparently very optimistic, said something like, 2025 is shaping up to be yet another record year.
So high confidence from the top. Are they backing that up with, actions, deals?
It seems so. The article gives a couple of examples. They closed their first infrastructure structured solutions fund.
Okay. How big was that?
Hit its $1 billion target. And they also made a strategic move with Angel Oak.
Angel Oak? They're in the credit space, right?
Yeah, Brookfield acquired a majority stake. Looks like a push to expand their credit business.
Interesting. So infrastructure solutions and expanding in credit. That sounds like broadening their base.
Diversifying, maybe.
Could be. Infrastructure often means long-term, stable stuff. Credit offers different risk-return profiles. Makes sense strategically.
Right. Okay, so that's the business side. Performance, growth. But what about returns for, investors holding the stock? Dividends.
Ah, yes. Always important. What's the story there?
Pretty positive, according to the article. Brookfield recently boosted its dividend by 15%.
15%? That's a hefty increase.
It is. And with the stock price under $55, that pushes the current dividend yield to nearly 3.5%.
3.5%. How does that stack up?
The article makes a point of comparing it to the S&P 500.
Which is yielding much less, I assume.
Yeah, less than 1.5% currently. So Brookfield's yield is more than double the broader market.
Okay, that's definitely eye-catching for income investors. That 15% hike suggests confidence, too.
It does. But you have to wonder, can they keep that kind of dividend growth going?
That's the key question, isn't it? Does the article touch on their, future plans, projections?
It does, yeah. And they're aiming pretty high.
How high?
They plan to grow their fee-bearing assets under management AUM to around $1.1 trillion by 2029.
Whoa, okay. From what starting point?
From $539 billion at the end of last year. So basically looking to double it in about 5 years.
Doubling AUM in 5 years. That's ambitious. Does that translate into earnings growth projections, too?
Yes. They're forecasting compound annual growth rate, 17% for fee-related earnings.
17% annually.
Which would double it to $5 billion by the end of the decade.
Okay. Any other growth metrics?
Yeah, distributable earnings. That's kind of the cash flow available for dividends.
Pretty much, yeah. What's the projection there?
They expect 18% compound annual growth for that, taking it from almost $2.4 billion last year up to $5.1 billion in 2029.
Right. $5.1 billion available to distribute.
And here's how it connects back to the dividend.
Yeah.
The plan is to maintain a high payout ratio,
How high?
around 95% of those distributable earnings.
95% payout. Wow.
So if they hit those earnings growth numbers,
Then that 15% annual dividend growth they're talking about?
seems potentially sustainable, based on their own roadmap at least.
It hangs together mathematically, yeah. But that high payout ratio also means hitting those distributable earnings targets is absolutely critical. Less room for error.
True. Very true. Okay, so growth plans look good, dividend looks good, and potentially growing. What about the price? The valuation? Is it cheap now after the dip?
The valuation question. The article tackles this directly.
Is it a bargain?
Well, it acknowledges it's not exactly a screaming value right now, even below $55.
Okay. What's the metric they use?
It's trading at about 35 times its estimated 2024 distributable earnings.
35 times. Yeah, that's not obviously cheap on a trailing basis.
Right. So you're paying a bit of a premium based on this year's expected earnings.
But I guess the argument relies on that future growth we just talked about.
Exactly. The article suggests the expectation is that Brookfield will grow into its valuation.
Meaning the earnings will catch up to the price.
Essentially, yes. If you look out to 2029 using their projections,
Right.
the stock would be trading at around 18 times its projected distributable earnings for that year.
Ah, okay. 18 times looks much more reasonable. Still requires them hitting those targets, though.
Absolutely. It hinges on execution. But that's the core argument. The growth potential justifies the current, slightly higher multiple.
So the idea is you get potential stock price appreciation as they grow earnings, plus that growing dividend income.
That's the total return picture they paint. Growth and income.
Which leads the article to conclude, what?
That this recent dip below $55 looks like, and I quote, a great buying opportunity.
Okay, so summing up the article's view, strong recent performance, big capital inflows,
Ambitious but detailed growth plans for AUM and earnings.
which support significant dividend growth.
And while the current valuation isn't rock bottom, the idea is they'll grow into it, making the current price attractive.
Right. So wrapping this up, we've looked at this motley fool take on Brookfield Asset Management. Despite the stock pullback, the underlying business seems strong, with solid recent growth and big plans ahead.
Plans that point to potentially significant increases in assets, earnings, and importantly, for many, those dividend payouts.
And the conclusion from this particular analysis is that the dip might be a chance to get in, especially given that dividend yield, which, as we said, is way above the general market right now.
Yeah. It definitely paints a positive picture, contingent on hitting those future targets, of course.
Which brings us to the final thought, really, for you listening.
Considering all this, the stock move, the company's own forecasts, that dividend appeal, what key risks, but also what potential rewards do you personally see? Not just for Brookfield, maybe, but for this whole alternative asset management space in the longer run.
Something to chew on.
Definitely worth thinking about as you weigh up any potential investment.